Good morning, folks. Good morning. Guys, give me a heads up on Twitter if the audio and volume is okay, and if you could see the ES chart. Thank you, Leon. The volume good. Not that I can do anything better than I'm doing now. My microphone's volume is all the way up. I'm literally within kissing distance. So that's where we're at with this, okay? All right, just bear with me 1 second, okay? All right, so today we embark on a topic that many of you have been chomping at the bit to get to, which is pushing the button. So obviously tomorrow we have FOMC, so that creates the likelihood of a rather slow trading session. A lot of folks just waiting to see what the Fed will be doing tomorrow. Everyone's making their bets as to what to expect, what not to expect. I don't know. Okay, so I don't ever try to go into the market and try to forecast the actions of the Fed. So I think anyone that tries to do that is just fooling themselves, or at least attempting to fool themselves. So while we're waiting for the morning session's opening range to complete, which is typically 9:30 to 10 o'clock, we keep a relaxed view on the marketplace. I'm not trying to go in with any kind of hard line bias yet. I want to let the market itself tell me what to look for. And all we're looking for this morning is a small little opportunity to get what I teach as a low threshold objective, which is 5 handles in the ES. So while obviously later in the year you'll see me do larger pulls where we're doing 20, 30, 40, 50 handle runs, there'll be days for that. Today's not one of them. So I kind of want to beat on the drum of how I teach all of my students to start with, which is a really low hanging fruit objective. I believe that anyone that goes into this with that mindset in terms of studying like that, not trying to get rich overnight, not trying to get rich in at all really, just trying to carve out an opportunity that repeats over and over again, that you like, that you can find comfort in seeing, being patient, looking for it, allowing the market to present as many advantageous signatures in our favor that would warrant a price move that is, at least by definition, the way I define it, high probability. So I'm willing to submit to a longer time than I normally am this morning. Usually I do about an hour or so, and then I cut bait or whatever. I'm going to try to stay with you this morning until we get an opportunity that fits my criteria. So I'll kind of give you the nuts and bolts as to why I believe it should do what I expect it to do. I want to preface it by saying, and most of you already know this, it's been with me for a long time, this is not a signal service, okay? Let me remind you with the disclaimer here as I talk. That disclaimer will be popping up a few times during this presentation today. It is not an invitation for you to copy. It is not an invitation for you to try to fix your drawdown. It's not an invitation for you to get your last little piece of your funded account challenge passed, okay? I'm going to give you certain exercises today, and I'm also going to tell you where I believe it's going to go. I'm going to inspire you to use your demo. Okay, I don't want you to use your live account. If you're trading with anything I say today, you're absolutely doing it wrong, and you're going to regret it. Okay, so what we're doing is I'm teaching my son, who is embarking on a funded account challenge. And I won't name the company here because I don't want to represent anybody, and I'm not suggesting that they're good or bad. I'm just saying that he's making an attempt to do so. That's where he wants to go with it. He doesn't want me to give him money to do it, which is great. But his concern as a new student of the markets, and he is absolutely green. He doesn't know how to do much of anything. So his concern is he's fearful of getting in. And that was one of the initial things I had in the 90s when I first started trading commodities. I was fearful. I didn't know really what I was looking for, and it was manifesting itself in my anxiety about when and what market I should be trading, what time frame should I be trading. And if you're new to all of this market stuff or even ICT content, it can be a little bit bewildering. You know, like what time frame should I use? What market should I trade? You know, what setup? What's the thing I'm looking for? And the reason why I teach the way I do is I present lots of different approaches to skinning that cat, but it allows you to bring in your own personality. Now today, unfortunately, I'm going to try to force one particular approach to getting in. And I'm going to try to utilize a fair value gap, which is predominantly the most visually easy thing to find in a price chart. Much like looking at equal lows that we target for sell side liquidity, that's where we think that the market's likely to draw to. Much like we expect equal highs to be a draw for buy side liquidity. Those types of things are pretty generic. You know, they're not hiding from you. In fact, it's next to impossible to not see them. Meaning, all we're looking for is a clear indication that the market's likely to reach into some level of buy side or sell side. And I'm submitting to not looking at anything this morning because I want to kind of like present the opportunity in the closest manner to someone that doesn't know what I'm teaching. So I'm limiting my perspective to just this 5-minute chart. Now, you don't want to be doing this, obviously, and the market just opened up, by the way. You don't want to do this if you're trying to trade with real funds. But trying to pantomime as close as I can to someone that would have a limited perspective, which is someone that doesn't look at higher time frame charts, someone that doesn't look at much of anything except for the chart they're looking at the time. And usually it's a 1-minute chart or 5-minute chart because me and other people on the internet have showcased opportunities that we're presenting on those time frames. So therefore, the audience members will gravitate to those time frames thinking that that's the only way to do it, when it's not. It's a good teaching medium for me because it gives lots of opportunity. Plus, it gives no room for any delay. Like it's right there on the fly. And this 5-minute chart may not be the time frame I'm going to use. I pulled that up to show the Monday closing regular session price, which is that 39.84. So just sticking to this time frame here, we're opening up with a premium in the sense that we are opening up with a gap from yesterday's close. So we've worked higher overnight, and if you go to your regular trading hours tab, you click on that, there's the gap we're looking at here, okay? So it's a very significant gap. Whenever it's like that, I like to see a little bit of a move to the upside to draw in the public, make them want to chase it. And then typically what it'll generally do, not all the time, but generally, it'll want to move back down inside of that range. And what range am I really speaking about? Let's outline that now. So using the regular session close price here up to the opening price this morning. So that gap, which is significant, going into this morning, I want you to focus on the potential for just trading back into that range that's shaded here. We're not trying to make the case that it's going to trade all the way back down to 39.8450. That's not an argument I'm trying to pose to you. What I'm suggesting is, can we see a 5-handle price run from wherever we trade up to, and I'm not trying to pick the top. I'm going to let the market indicate that it's stopped, at least for the short term, going higher. I'm not trying to go long. I'm going to try to look for something that gets into that range here. So I'm giving you a directional bias that I'm looking to operate in. Doesn't mean that it can't go higher. Doesn't mean it can't go down to the previous session closing price. We're not trying to forecast that. Remember, the argument here is, how does one conquer fear of getting in? How do you conquer that? And you probably had anxiety, especially if you got lucky enough to get a funded account where you've passed the challenge, and now they give you the funded account, and then suddenly you're met with this new anxiety, this new. Let me go back to the electronic session now. Just be mindful that this shaded area here, that's our opening range gap. So where we closed yesterday or previous day to where we open, that's what's being highlighted there. Okay, so when I drop down into the electronic trading hours, that shaded area is what we're representing there. Okay. So when I first started in 1992, I was admittedly in a rush to get the account opened up, but then once the account was opened, I was frozen with fear, and everything I was looking at on the chart seemed like it was Greek, whereas I thought before I knew what I was looking for when I really didn't. But I was fearful and paranoid about doing anything because I was afraid of that first trade being what? Wrong. I was afraid of taking a loss. I was afraid of doing it incorrectly, and no one knew what I was doing. They didn't know I had money in the account. They didn't know me as a trader. I wasn't online. I wasn't an inner circle trader yet. I was the guy that just opened up a trading account with Fox Investments, paying $100 per round turn, per contract. Yes, it was robbery. But that's what we were told that was the normal back then. So a discount broker was like Lynn Waldock, where you paid $30-some per contract. So I was fearful, much in the vein that most of you would have, doing it wrong. But I was also afraid of, because I only had $2,500 in the account, which was extremely under capitalized. Like I didn't have enough money. So what I was thinking was, not only do I have to be right about my trade, but I also have to be right about my entry, not going into too much drawdown, because as soon as I put the trade on, they're going to do what? They're going to take that commission right out of that. So I got to cover $100 right away. So if I'm trading the grain market like soybeans, I have to have at least 2 cents of a move, because each penny move is 50 cents. $50, much like an ES mini contract. So I was already overthinking everything, and that anxiety caused me to be much like a deer in headlights. And let me also talk about, real quick, this is about teaching you how to overcome fear. It's not about teaching you to follow me and use it as signals, because I know some of you are here just for that very reason. If you're not listening to what I'm teaching, it's not going to be beneficial to you. I could get out here and push the button and be right all day long, but it's not making you better. It's not teaching you how to do it on your own, which is really what I'm trying to do here. It's the only reason why I'm even doing live streams, is to show you how to do it. And my son, who's hopefully going to learn from this, and he wasn't privy to all this stuff that I'm talking about now, because he wasn't interested in trading. He's a typical teenage kid, video games and high school antics that kids do. But my concern, much like all of yours, if you've ever experienced fear, and some of you probably are fearful of doing it wrong even in a demo account. I've had many people reach out to me that they have ruined several demo accounts not knowing what they're doing, and they're just so frustrated they can't even get to the point where they can push a button there, which is extreme anxiety. But you're placing too much emphasis on the outcome being perfect for you. In the beginning, as I'll show you today, you want to exercise and do drills. And I'm going to teach you how to cope with the initial fear of getting into a market move and not worrying about that outcome being profitable. Now, before I close the session, obviously my goal is to find something that moves 5 handles. That's obviously the intention today. But I'm also going to present opportunities where I want you to think about what you're being shown in the chart. I'm going to point to something and ask you to conceptualize what it is I'm pointing at. And does it make sense to utilize that as an entry versus the ones that you'll actually see me push the button on. Now, it's a skill set that you'll obviously learn over time, but you can't just expect with a live account, whether it be a funded account or your actual funds in a traditional broker, you can't expect those types of conditions just to materialize magic and all of a sudden now you know how to trade because you're using real money now, which is the reason why I'm an opponent to anyone teaching that people should just learn how to trade with real money. You don't learn how to trade with real money. You learn how to engage risk where you didn't have that before in paper trading and demo trading, but you learned how to trade with a demo. That's what a demo does. The demo is not just to familiarize yourself with a platform or a broker. It's absolutely to teach you how to trade. And anyone that says otherwise is just a fool. And that's the bottom line. So we're looking at a market that has a little bit of a mixed bag this morning, much like we had yesterday. I was calling most of everything you saw yesterday in ES on my Twitter feed, so you can go back and take a look at that. But today we have the dollar index. It's come off of its lows from 930 back into the range that was formed from 915 to 930. I'd like to see it mount a run above. You're welcome to check your charts. I don't want to toggle too much and make the mistake of losing audio. The high of 103.13. I want to see it trade above that. That would indicate that there's likeliness to see the shaded area on ES be revisited. And again, we're just looking for an opportunity to frame a 5-handle run, which is not a lot. And right away, you should be thinking, you know, how much could I be risking with that? Well, when you first encounter doing entry drills, where you're practicing with your demo account, with your paper trading account, which is how you do this, you're using one contract. Now, I know some of you out there that are trying to make a name for yourself, trolling and making up a bunch of nonsense. You're going to go out there and you're going to say, but I trade 40 contracts and 30 contracts and blow my account out in front of everybody on live streams and pretend it doesn't happen. What we're doing is trying to teach you how to overcome the fear. That fear, that anxiety is rooted in, number one, the leverage. Right away, the easiest thing to do to remove fear or to squash it, any anxiety, is to remove the leverage. Dial that back. Just because your funded account says you can trade with 15 contracts, that's not an invitation for you as my student to think that that's appropriate. That's a lot of risk for someone that's just now getting a funded account. I mean, you're new. You don't have the experience. You have no idea what it feels like to watch an account balance fluctuate with that measure of capital on each point fluctuation. So you want to start with one contract and you want to desensitize yourself, because that same 5-pip handle, or I'm sorry, that 5-point run in ES, you can do the math, and over time, when you can graduate to 2 contracts, 3 contracts, 4 contracts, or even up into that 15 contracts per trade, you'll have the experience working with price action that's associated with real monetary loss and potential gain. You just can't simply go out there and say, well, I'm ready for it now. I'm gonna go out there and just plunge into whatever the amount of contracts they allow me. I'm gonna do that. I mean, I was teaching predominantly the Forex markets. You know, I mentioned it many times, just because you can leverage as much as you can leverage with the broker. You should not be doing that, because all you're doing is increasing the likelihood that you're going to blow, you're going to lose, and you're going to be fearful the entire time you're in the marketplace. So you want this to be very boring. You don't want to have any kind of emotion attached to it, any kind of excitement, no kind of fanfare. Because if you remove all that, your attention is going to be on price action, not how much you can make or worrying about how much you're going to lose. And that's unfortunately the case with most new traders, is that They want to gamble, much like the lottery, and how much they can put on the bet and just hope it works out in their favor. Not realizing that if they just did very little risk, they can take lots of trades and still stay in the game long enough to get the eventual outcome that they're looking for. If it's not get rich get rich overnight real quick, because that's not what you should be doing here. So far we're just marking time on ES. Hasn't done too much of anything. I'm looking at the NASDAQ. It's not doing much at all either, but the Dow is certainly weaker. It's coming off of its run higher. It's posted this morning early on. And I'm watching, there's a volume imbalance at 103.06 on the 1 minute chart of dollar. So my eye's there. I want to see it kind of respect that, and still pressing to 103.13. That rallying higher on dollar would be risk off near term, meaning that it's easier for foreign currencies like British pound versus US dollar, Dow, NASDAQ, and ES to trade softer, go lower. It doesn't mean I'm picking the top. It's not an indication that it's going to crash. All I'm saying is it puts things in motion that would be likely supportive of weaker, lower prices. We already gapped higher. It's already had that initial move higher. There's this consolidation. They broke out. Traders that use this type of idea to buy on a breakout, they're already in this here. I'm going to drop down into a 1 minute chart now. Actually, let's just go through 4, 3, 2, and 1. Okay. So the exercise I'm teaching you today, when we get into a setting where there's an opportunity there, because there's nothing here yet. Remember, the first 30 minutes as a trader trading with ES, you want to be willing to submit to the first 30 minutes. It doesn't mean that you can't find a setup. If it's there, if it's obvious, then obviously, then you can. But as a rule of thumb, general rule of thumb, you want to submit to those first 30 minutes. Because sometimes there's reports that come out at 9:45, not today, not every day, but sometimes that occurs. Also, the initial move right off the opening generally is not the right one to be placing yourself in front of risk. So meaning it could be a Judas swing, a fake move. Okay, so we want to allow the marketplace to draw in the gamblers that want to trade in near the first couple minutes of trading. Okay, and you want to just relax, slow down, and remind yourself that you have plenty of time. Plenty of time. You have the entire day to find these measly little 5 handles. And you don't want to rush just simply to get it out of the way, because that's also another thing that you're going to feel like you want to trade. You're also initially anxious about doing it incorrectly. So one of the things you're going to feel is, all right, I'm in front of the charts. I have my account. It's funded or it's real. And I got to just get in here and get it out of the way. So that way I can make my money and close the charts and just be away from it. What you're doing is you're conditioning yourself to hate trading. I went through a phase like that. After a few accounts that I ballooned in the 90s, that feeling of, I just want to get in there and get my money and run away. I was conditioning myself to be afraid of it, which is what made it almost impossible for me to grind through to a point of not being fearful. That's why I have so many execution models that lets me get into a trade. I have lots of opportunities to get into a trade that allows me to participate in a move. And the reason why I have so many weapons like that is because that was one of my strongest barriers. I was afraid to enter because I didn't trust the model that I was working with was a good one. I didn't have enough experience seeing it work. I was in a hurry just because I saw a few of them work, and sometimes they didn't work, but I blocked that part out. And that's another thing you need to be aware of. When you do these exercises and these drills, don't block out the times you do it wrong. Don't do that. You want to make sure that you learn what you did incorrectly in those, and don't try to put blinders on thinking, okay, well, that didn't happen. No, you need to know what you're doing, because if you don't address the issues that you're doing incorrectly, they're going to repeat. And if you're doing it with live funds, you know what's going to happen. Eventually, it's going to wear down that equity or wear down your mental capital. And between both of them, you will blow your account. So preservation of capital is the first and foremost important rule in speculation, whether you're doing it with paper trading, demo, or eventually in live funds. So right away, again, we're submitting to that first 30 minutes. Nothing's happened so far today. Dollar's firming up. It still hasn't gotten above that 103.13 level, which is what I'm looking for. I want to see it get above that on dollar, 103.13. That's the level I referred to earlier. Here's some weakness we're looking for. That right there. Okay, now, right away, your eye should jump to these clean lows right there. You see that? See that right there? Now, what's resting below those lows? Sell side liquidity. This low here, we had a displacement below it. We're trading back up into the imbalance here. So the risk would have to be, where are we at? We're on 1 minute chart. $40.20 swing high. 40.25.75. Okay, so do we offer an opportunity to see 5 handles in this area here to that level here? Yes. That's not bright enough. Okay, so now what I'm doing is, as I'm watching the ES here, I want to see it drop below, just to trade back inside this shaded area, and also gravitate towards the sell side liquidity. And I'm watching the dollar index. There's a small little imbalance that it's trading on. Let me tell you the candle right now. If you look at the 1 minute chart, it is the 944 big green candle on the 1 minute chart. I'm watching, does it respect that? In other words, does it want to send dollar higher while I'm watching ES? So what we would be doing is, the initial drill is 5 for 5. That means you're going to risk 5 handles to make 5 handles. I already know there's going to be individuals in here thinking, oh, that doesn't make money. It makes money. But you don't need a high rate of multiples for You don't need a 5 to 1, a 10 to 1, 20 to 1 R multiple to be profitable. If you have a strike rate that's pretty high, you can do 1 for 1. But while you're training yourself, you don't need that. You can just do 1 for 1 because you're conditioning yourself to get over that fear of missing, or not missing, the trading, because you're afraid you're going to either miss a move or you're going to take a loss. I'm still watching that dollar. This in here is not as clean as I would have liked to have seen it. I would have rather had not seen that little move here, but I'm giving it an opportunity to see if I can see that run up on dollar on that small little buy side balance, sell side efficiency. And again, we're still in that first 30 minutes of trading. So this is all part of that. What are you looking for, ICT? What are you waiting for? What do you look to see? What do you want to find in price action? What is your focus? What don't you like? That's what I'm doing right here. This is how you mentor someone. It's just not blindly going in there and just taking a trade. Now, let's just say, for instance, let's play devil's advocate for a moment. Say this starts to break lower. Okay, say it breaks lower and I haven't gotten in yet. I can use the top of that shaded area and the midpoint of this wick here, which will be consequent encroachment. In other words, if it traded down here but didn't trade below here yet and traded back up into it, I don't have a problem with that taken as an entry. Now, you might not be comfortable with something like that. I'm not trying to convince you that that's the model for you. All I'm saying is how do you overcome fear of entry? That's the whole topic of the day. But I'm wanting to trade with an entry with a fair value gap. That's what I'm trying to force my focus on. That way, at some point, it's going to give it to me. I just have to wait long enough for it to happen. It's going to happen every day. There's one. But you don't have the patience, if you're new, to wait for it. And since we have nothing in here, did I go short? No. Why? Because there's no fair value gap. I wanted to see a small little portion of that down closed candle left open. Then a new candle start, and then it trade up into that. Then I would have sold short right there, targeting these lows. But if I don't have what I'm looking for in the chart, I'm not just going to think, well, I got video games to play. I got to do something here. Or my wife's going to be asking me to do something, and I won't be able to be in front of my charts. Not that she does that, but you know how it is in the real world. You get pulled away from doing this, and they're wonderful little distractions. So dollar index did not respect that fair value gap, which is what I was watching for. It went a little bit deeper than I wanted to see, but it does have a wick. If you look at the wick on the candle 1 minute chart for DXY, the 943 low, that wick on the low end of the candle, we've just dropped down into that. So I'm trying to watch and see if we get some kind of respect there and go higher. But I don't like where we are with ES. So we might need to go one more time higher on ES. NASDAQ looks like it wants to flirt with a higher high also. But the Dow is just a dog right now. Let me pull up Dow real quick since there's really nothing here at the time for ES. My focus is primarily on that market. So that's the difference between the Dow on the 1 minute chart. Lower, sloppier. And then on NASDAQ, we have that. So we have relative equal highs. It looks like we could run up in there and hit that. And an ES, we have this. So we have relative equal highs here. Small little gap here. So if we traded down there to that, to 23 to 28, that would be 5 handles. Dollar's just hanging around still, not confirming or denying anything. This is the part, this is the time that is excruciating for inexperienced traders. You feel like, okay, you showed up, You're here. ICT says he's going to push the button today. And you're ready. You're chomping at the bit. You can't wait. And that's exactly how it feels when you get in front of a chart when you have live funds at your disposal. You want to do something, but then you're also, I'm scared. What if I do it wrong? Everything's a second guess. And you're in a hurry. You're just in a hurry to get in it, just to do something. And that's the trap. You have to still remember what you learned about trading in a demo. You have to remember those lessons. You have to go back on that experience, because if you don't refer to that or even have gained any of that experience, you're going to be impulsively just pressing the button. And there has to be something in the chart to do a entry on. You just can't just gamble and see what happens. We're saying that it can go up to that 40.28 level. I'm not interested in taking that. But that's a move, I see. It is. It's a move. But I want to use a fair value gap today. That's my focus. I'm confident it'll form. I'm just trying to exercise discipline to show you what it's like to sit through all the other price action moves. I don't care who's making money on YouTube. I don't care how many people's posting things on Twitter. That's not my trade. That's not your trade. You can't go back in time and enter when they did, if it was even profitable at all. So you have to submit yourself to this process of learning. Should pop up through there and hit that 40.28 level. Still very, very mixed, which is typical ahead of FOMC. So you have to be a lot more nimble on days like this, and also by lowering your expectations. So now think about what's actually occurring here. The market's gapped up at the open. We had a small little rally higher, and we've dropped, but we have dropped aggressively. There was no real energetic drop. See that? The only thing we had here was this drop down here, and it quickly, with the relationships of intermarket analysis with the dollar, it canceled out any short here. And if you missed it, it'll be in the recording. Go back and listen to it. There's the pop, the 40.28. So in my mind, I'm thinking anyone that's already trying to sell short the gap higher and the initial high that's being formed here, this run here kills them. So now I'm watching very closely how that dollar index go back to that original fair value gap. That means the one at the candle at 9:44, 1 minute dollar index. If we rally here, because we cut through candles, we're not supply and demand. Cut through the candles that's been formed over the last 7 or 8 of them. Go back to that fair value gap. The candle we're in right now basically is already traded down into that low of that fair value gap. And I want to see, does it rally higher on dollar? And if that does, this high here on ES could be suspect, meaning that it's just a run on buy stops or anyone short, and then we could look to see it traded into that 420 or lower. But it has to do so in price. All we're doing is anticipating the likelihood of that right now. Man, my back. And what I'm doing is my attention is going through euro dollar. And I know some of you are like, what are you looking at euro dollar for? I'm looking at euro. I'm looking at the pound dollar. I'm looking at the dollar index. I'm looking at the relationships of that triad and trying to get a measure for where risk is. Is it risk on or risk off? And euro is just consolidating. It hasn't really done much at all since around 7:30. It's been in consolidation. Dollar, like I said, it came off its lows at 103, and I'm still looking for that 103.13 to be broken to the upside and how we trade there. hasn't gone below on dollar index. It hasn't gone lower than the low formed at 954. 954 is low. And now we have ES coming back down below these highs here. Okay, dollar's looking favorable now. So now what we're going to do is we're going to wait to see if this high stays in place. If we break lower and create a fair value gap in here, between where? Between this low and the high that's formed. We're using that price leg there. So inside of this range, this is protraction. It's done what? It's taken buy side here with this rally up. So inside of this price leg, we're anticipating now a fair value gap to form. And if it can form, I'll use that one, excuse me, I'll use that one to try to get a run for 5 handles. Now I don't want it to go too fast from here. Brett's like, ICT's trying to trade it. Don't give it to him. Reprice it lower. No fair value gap. He's going to convince everybody today. You can't do it all day. And I'll stay here long enough to do it. Okay, so you can see already, like if we were using turtle soup would be that run above and just going in there and, you know, and shorting it because we have a divergence between the Dow and NASDAQ and ES making higher highs. Dow didn't do that. All right, so I want to see this candle here create the fair value gap right there. I don't want to see it go up and have an immediate rebound. So I just want to see it close this candle, open another one, then trade up into it. But not take out that low yet. I don't want to see that happen yet. And it looks like it's trying to run. Dollar indexes nicely ran up into the level I was wanting to see. Beautiful, beautiful. And we do have a fair value gap here. So you can do one of two things here. In your practice, you can set a limit order here at this high plus 1 tick and then use a stop of 5 handles and then use a take profit of 5 handles. Or you can wait for it if it can trade up there, and that's, like I said, I'm running the risk of not participating on this one because it's already running and not giving a return back to it, which is fine. But you didn't get in, ICT. I know. There's lots of moves that I don't participate in, just like you're going to discover. Now we have a breaker. Okay, so while I don't want to utilize this as my entry, I do want to bring it to your attention because it's here now. The breaker is where we have a high, a low, and a higher high, where it has taken buy side as I outlined in real time. This buy side that's been taken, our attention goes to the down move prior to the secondary higher high. So in other words, in short, the low between the two highs. So where's the down close in that low here? These candles entirely, all of that range. 1, 2, 3. 1, 2, 3. So inside this range, that is a bearish breaker. So let's just say it goes up into this fair value gap here. You can short it, but you have to incorporate this because it can trade up into that as well. Because it's a fair value gap within the breaker. So ideally, I'd really want it to trade up into here, but it may be asking too much of it. So I'm going to do a lower probability entry. If we can go right above this high here, I want to see it one more time, pump into that once more. I'll go short, risk 5 handles, and see if we can get 5 handle run. The liquidity is obviously sitting right below 4014.25. So 401425, all this smooth lows here, there's sell stops resting below that. So if smart money has sold short up here, collecting what? The buy stops. So they sold to those buy stops with this run here. So where are they going to try to get out at? Ideally, market efficiency paradigm is they're going to buy from sellers at a lower price. Markets here. Where are sellers at a lower price? Below these equal lows. I can enter here, but my 5 handles doesn't provide me enough shield where we are in that range with this fair value gap, which is also one of the things you have to contend with when you're trying to take entries. Just because you feel confidently it's going to go to a specific level, you still have to consider the risk. And just because you might be right about where it's going, you can't chase it. You got to trade in a premium if you're going short. That means trading in a up close candle. It's one of the filters that many times is going to serve you better than you realize now. If you can sell short and up close candles and buy and down close candles, you're giving yourself an advantage that most traders don't realize when they're trying to do entries. Give me that. No, the one next to it there. I want to see it get into this one admittedly. That's what I'm watching and waiting for. Now, I just pressed that button. It took forever to get it in there. Okay, and now you just submit to it. If it takes you out, that's fine. If it stops you out, it's fine. And you want to submit to the idea that how much time does it take once you enter the trade? How much time does it take for you to see it move in your favor? Or if it stops you out, how fast did it take you to stop out? Now, obviously, I'm using a fair value gap entry, but I'm using the context of that breaker. So it kind of like allows for more of the things I like to look for in price action, but framing it is, being utilized with other tools. But hopefully you can at least see that the reason why I'm entering is in that fair value gap right here. Okay. Now there's a small little volume imbalance in here. I want to see it trade through that and not get back above it once it does go below it. Now you reduce the risk, put it right above the breaker. That way if I'm stopped out, it's a small little loss. Now all you're doing is studying price action, watching, does it still continuously deliver, wanting to get down into, I have it set to this low right here. But if I had more, let's go back to this idea where the sell side is, okay? But when you're practicing, you want to have a 5 for 5. 5 risk, 5 gain. I want to see it right here stay heavy and go lower. That would be an immediate rebalance. In other words, kind of like a fair value gap return and then drops. I want to see ES remain heavy. And I want to see the dollar climb back up into 103.16 area. And also you want to indicate in your journal that you're trading ahead of FOMC. So you are in a market climate that is not conducive for high precision. It's not conducive for low resistance liquidity run. It means the easy salad days type trading. That's not where we're at. But you want to practice in these conditions, because by practicing in these conditions, you're preparing yourself really for the best when the market's more free to move. In other words, when it's easier to see it rally or drop into levels that you expected, when it's just real sudden movement, all one favor, just digging into it. That's the type of trades I teach my students to look for. I look for that as a signature in the marketplace versus just simply, well, the markets are moving today, the markets are trading, so therefore let me just go out here and try to make money. That to me is not enough. My eyes watching how we traded that low. I want to see it trade to that low and expand quickly to get these sell stops. That's what I'm looking for. Just a little bit of a movement up $1 so far. I want to see it really get aggressive and dig into that 103.16 and higher. Now you want to remove the risk because you've gone into new sell side. If it stops you out at this point, who cares? But because we went to this low here, the market can go back and revisit premium arrays and still not go to that sell side, which is the reason why I removed the risk. And now you just submit to either one. Either it stops you, which you're fine with. It'll be stopped in profit, and it would be a favorable outcome for the exercise. Or it goes to your limit order, and it closes your case study out, and you log it, and you record immediately. You don't go to social media and parade around. Or if you get stopped out, you don't go to social media and complain about it. You go right to your journal. You journal your entry, suggesting what? All the things positively that you did in the trade, the observations. Now you saw it trade down there, but it didn't take the limit order, and it was way significantly enough below it. They could have done it. There you go. So there you go. ICT's never going to do a live trade. He's never going to call the market. He's never going to explain it, but yet here I am doing it. How about that? It's almost like it's pre-recorded hindsight. Is that precise enough for you? So what you want to do is you want to go through how much time did it take for that trade to deliver. Obviously, I did a little bit more than 5 handles. But, I have to work with what the market's going to give me, right, folks? So right away, you should be thinking, and your corners of your mouth should be aching because you watched all this happen and you can't believe it, I know. But this stuff happens every single day. It's been happening for the last 30 years for me. It's been happening before I was born. Okay, these markets are absolutely rigged. Okay, they're absolutely rigged. There's no randomness to it. The only thing that is going to be random is your emotional impulses when you're not equipped to know how to trade. If you don't know what you're looking for, you're going to lose. If you know a model that you know what you're looking for, then you can aim for that and you can measure your progress. But you're not, okay, you're not going to hit the target unless you have a target. What's the target? Consistency. You're looking for something that repeats over and over again, that's highly precise. I want you to take a step back for a moment, okay? And folks, understand this is not bragging, because 10 handles is 10 handles. It's not that big of a deal, okay? But you can make a mountain of a career doing that. But I want you to take a look at what this chart looks like right here, right now. And I want you to go back and listen to the recording. There was absolutely zero anxiety. There was zero emotion. I was not hopped up on goofballs. I wasn't worrying about the trade panning out. I gave you exactly what I was thinking because of 30 years experience doing it. I'm lending my experience and what I'm thinking while I'm watching price. I told you the very things I was looking at, why I was considering it. I told you about the breaker. I told you how to frame the breaker, where it should stop. Did it stop at the high of the breaker? To the tick, baby. To the tick. This up close candle, this up close candle, and that up close candle. That's all my breaker. That, look at this price right here, okay? Up here in the upper left-hand corner, you see that right there? That high is 4025.75. The high of this candle comes in at 4026 even. So it went one tick, which is a mohawk. Remember, price has to go up one tick to allow delivery of perfect old high. Think about if you had a limit order. It has to move. The difference between the bid and the ask is one tick. So it has to do what? It has to at least go up there to offer the opportunity for that high to be booked. But that framework, think about the questions that many of you have asked, and you probably are listening and now had the answer given to you. How do you know ICT? How do you know that when it was rallying like that, how do you know that it won't go above that high there? Think about what I went through this morning with you, okay? I opened up the chart. I showed you this shaded area down here. Okay, we'll go back into that regular trading hours there. So the difference between yesterday's closing price and regular trading session to where we opened today at 9:30, that separation, that distinction between those two price points is important. That's the opening range gap. So if we open to a premium, it opens like it does here. It rallies, comes back down, rallies once more. Perfect. Perfect. We're watching now to see that fail. Go back and listen to my commentary. I'm not concerned it's going to keep rallying higher because it's already done enough of that overnight. This is a trap. This down here allows them to do what? Chase it. Longs can say, okay, I missed the initial run up here. Bears go short here. They put their stop loss right above this high. The market drops down into that opening range gap high and then rallies. Go back and listen to my commentary. I did not take the short that I was interested in if it would have kept that candle with a fair value gap. I would have shorted that then. But because I was using the dollar index to filter, it kept me from doing what? Getting in prematurely. Plus, the structure really wasn't all that. It was just not, it was not there yet. So I mentioned that how looking at the other markets, I said, okay, it looks like NASDAQ is looking like it wants to make a higher high. Let's take a look at NASDAQ real quick. I hope you guys can see this is not just random made up stuff. It's a logic behind all this. So there's those relative equal highs. I said we would like to run up above that. It did that. Look at the Dow. See that divergence there? That's why I was trusting that we were not going to go higher, and that was absolutely a good breaker on ES. So let's go back to ES. I'm answering all your questions. If you just listen to the boring stuff, folks, it's there. There's a lot of people probably started watching this video and said he's talking too much and missed the entire move. But this down close candle, these series of 3 down close candles, is the context behind that run up here that stops out anyone that was going short here because they want to do what? They want to fade the gap, right? Okay. The algorithm knows that. It's going to come down, rally through it. All the buy stops are gone. Why is that useful? Just like I mentioned to you. Smart money will sell short to those buy stops. They're going to sell to those buyers at a higher price. Smart money is accumulating oh my goodness. We're getting sleepless in Allen, Texas tonight. So we're looking at this area here. Up in that area, all here, that's where smart money's going short. Okay, so they're selling short there with the expectation that they want to do what? Buy it back at a cheaper price. But who would be willing to sell it to them at a cheaper price? Think about it. Who would be willing to do that? Anyone that's long here or went long on here, it's the idea that this is support, where they're going to place their stop loss, where they just got wrecked. So when smart money's considering entering a short, the market efficiency paradigm that I'm teaching you, the way they engage price, they're not looking at patterns. They're looking at who they can take to the slaughterhouse. They killed the people that were short. When it ran above it, they're done. They're stopped out with a loss. Anyone that was short here gets stopped out. Anyone that went long down here, oh, it's gap and go day. No, it's not. Listen to what ICT said. We're going to rally up, take a new high, and then we're going to watch and see, does it peter out? And it did. The market goes back down and takes out the longs. So who's really right? Who I told you was going to be right. The smart money selling here, and they're going to be buying down here. So when I'm looking at price, I'm looking at this to that. Shorting, buying it back. But because I told you I was going to limit myself just to using a fair value gap as my entry, I have lots of tools. I could have very easily sold short up here, broke my rules just for ego purposes, and then wrote it down here. That would not have been what I went into this teaching for. I want to teach you how to do what? Look for your model. So if your model is the 2022 model, you just watch me do it. You literally just watch me do it. The context is selling at a premium. If you can't get that price and you're submitting yourself to what? Like I taught in the 2022 model, wait for the displacement. This is the shift in market structure, right below that low. Then we have two fair value gaps. You can sell short in here, but you got to incorporate this fair value gap too. Why? Because it's inside the breaker, which is what I outlined here. And the market does what? It rallies up. I am not concerned about it making a higher high because we already have at that high versus this high, the Dow has made a lower high. That's SMT. That's tipping its hand. The algorithm is showing its crack and correlation. It's telling you, much like I was telling you, that this rally is a suspect rally, meaning it's only going up to take the stops out for anyone that's short. Don't believe me? Go back and listen to the recording. It'll be there. But I'm not concerned about it going above that high because I know that the algorithm is going to refer back to that candle's high because the context that books price in this algorithm repeats. It's not random. It's not milling. It's not milling through a whole different range of ideas and retail things. It's not looking for what retail logic is it going to use today. It's going where orders would be resting. It's going where inefficiencies are. That's the only thing it does, folks. That's it. Or it does this, sideways. It's going up for buy side, or it's going up to go into a premium fair value gap, some kind of inefficiency. Or it's dropping to old lows where there's sell side. Or it's dropping down to some discount inefficiency. Now, look at it through the lens of the 2022 model for a second. We see a high. The market rallies up. Did I use any other time frame? No. I traded right off of this time frame here, using the tools that I've already taught you in 2022. So if this market's going up and you're new and you're afraid, I'm afraid to trade ICT. How do I get over the fear of that? Follow the rules. The rules say wait for it to go lower. Where? It's got to go below a short-term swing low. It does so here. Trades below it, go through. Does it have a fair value gap? Remember the range I told you from here to here? Let's go back up through that. In that range, all of this is protraction. So in that range, when it starts to drop back down, we're going to be anticipating what forming? A fair value gap. There was two of them, here and here. The rules I gave you in the 2022 model last year was if you have two fair value gaps, you have to at least allow for price to trade up into that second one, because it can. But more specifically, because we have that breaker there. Because the breaker is a factor here, we have to at least make an allowance for, I'm on the wrong candle, sorry. You have to make an allowance for it trading up to the high of that. So I'm not concerned if it goes to that candle's high in one tick or two. I'm not concerned about that. I'm not freaking out that it's going to go above that high. Because if it did that, that's fine. That means I'm going to go bullish now. Because it would erase and cancel the SMT divergence between the Dow and its lower high when the NASDAQ and ES, like we show here, made higher highs. So it would be a stop out on one trade, but it would give me insight into being a net long trader the rest of the day. Because it should not have failed. See the difference between fearing being stopped out and allowing, if it does, then I'll change my bias. That's experience. That's someone that has been here before. And I'm not reacting to price. Did anything that I outlined this morning seem or indicate to you that I was reacting to anything? No. I literally outlined everything you see in your charts here. This is where the price was going to gravitate to. It was going to make a higher high. The model for 2022, if you take the low, well, let's just do it. There's the low up to the high right there. Here's the 50% level. That's equilibrium. So we have to find something as a discount below that level. Well, we have these lows, this low, and then these relative equal lows here. Which one's more likely to have the bigger pool of liquidity below it? Obviously this one here. And it's nicely below the 50% level. So we're in a discount. And we smashed all the way down into it. 10 handles. I like to over deliver. I told you I'd give you 5. I gave you 10. But you could have very easily, if it was your exercise, once it got to 5 handles, collapse it. And then watch it the rest of the time. Using the logic that if you were still in it, how would you be feeling each time it creates a new candle, lower or higher against you? This move right there, that's my classic teaching of the breaker. This is what you're all familiar with. But like I said, just because you watch those introductory lessons, those core content lessons, that's not mentorship. That's the language. My students have to know those things before they can really learn how to use the things. I'm not upset about those core content lessons being shared around. It was intended for it to happen. That's viral advertising. It was seeds in the minds of everybody that got their hands on it. And I don't feel bad about putting them on my YouTube channel. And my students that are mature, that are able to do these things now, they don't care that those videos are up there. Because they know that there was thousands of videos outside of those. That's where the real mentorship was. And they're not going to help you because they're old. Like you just watched this one here. You watched it pan out real time. Exactly how I teach. There was nothing contrived here. Nothing random. And it should bolster your confidence that what you're learning and who you're learning from can do it. Precisely. Accurately. With no emotion, no pomp, no ego, no bragging. It's just the facts. This stuff works. This is the market. It is the market, folks. It's not pattern stuff. It's not indicator stuff. All I drew on this chart was the logic to help you see it like I see it. Because the entities that I dub and refer to commonly as smart money, that's not the same people you think it is. It's not a market maker. Market making is algorithmic now. There's no person that's a market maker. You may hear them be referred to as a market maker, but they are a dealer. That's all they are. They're not making the market. They're not controlling price. They're not sending price to a specific level like this algorithm is. Now, my question to you is how on earth, if there isn't an algorithm, how can it be that I can see these things so precisely before the fact and explain it to you before it happens, and your real-time chart paints it just like I'm showing you mine is? Because there is an algorithm. And I'm sorry if that upsets your entire paradigm, if that conflicts with your teachings, your mentorships, your logic, your book sales. I'm sorry. I'm not meant to, upset you. I'm here to open your eyes to what's really going on. And I could do this every day. And damn it, I'm ready to do it in court. I can do it, baby. Let me do it, because I'm going to smoke your ass. Please. Pretty please. With sugar on top. Hope you found this one insightful today, folks. Until next time, be safe.